PayPal stock, ticker symbol PYPL, was up 2% today after reporting Q1 earnings that were fairly mixed. We did see some initial volatility here at the start of the day, but after pairing some of these losses, the stock actually put on quite a show, up 2.23%. And we're going to talk about PayPal. We're going to talk about the earnings, and we're going to ask and answer the question, is PayPal a buy right now at $66 per share? But before we dive in, could you please go ahead, like this video, subscribe. It really helps a small channel like mine out. Let's dive in. Now, let's quickly talk about the earnings. Now, the company reported first quarter revenue of $7.79 billion or $7,790 million. That was 1% growth year over year. That missed analysts' expectations of $7.84 billion. EPS, however, due to PayPal's price to growth strategy, saw 56% growth, beating analysts' expectations by a very wide margin. Last quarter, EPS in the previous period was about 88 cents, so we saw massive growth. And now you can understand why the stock did what it did. The initial volatility was because we actually missed analyst expectations on the revenue side, but the ensuing rally was because the earnings, the underlying earnings, were very good. PayPal management also reiterated their guidance. They said for Q2, expect anywhere from 3.75 to 3.8 billion in transaction margin dollars, which is their version of net income, representing 4 to 5% growth over the same period last year. And you're looking at about $1.30 of EPS at the midpoint, representing 8 to 10% from the same period last year. But we'll talk about the full year guide and the Q2 guide a little bit later on in the video. Looking at the margin profile, this was probably the highlight of the report. Margins expanded across the board. Gross margins expanded from 39% to close to 41%. Operating margins expanded by a lot, nearly 400 basis points. We saw nearly 500 basis points of margin expansion in net margins. This was the actual highlight of the report, and that's why net income was so good. However, free cash flow actually fell. However, this was largely timing impacts from their buy now, pay later activities. They sell a whole bunch to KKR. And when they sell those, when they report those, and when they distribute those, it really does impact free cash flow as a whole. So next quarter, you're going to see a massive boon in free cash flow. That's just how PayPal's business model works. Net income increased handily, and PayPal's balance sheet looking very solid, sitting on $15 billion worth of cash, $12 billion worth of debt, about a $3.2 billion net cash position. That is what you want to see. Diving into the earnings more granularly, so you could see your revenue up 1% from about $7.7 billion to $7.79 billion. Nothing exciting there. However, when you actually look at how their operating expenses evolved, you can see why margins expanded so much. Transaction expense actually decreased 7.3%. So that goes to show that the underlying business of PayPal, the actual payments transactions, is costing less. And so they're definitely doing something right in their software and during the transaction chain. Customer support and operations decreased by 12%. Restructuring decreased by 68% from $212 million to $66 million for the quarter. And that resulted in total operating expenses falling 4.1%. And that is why we actually saw net income increase the way it did, and then earnings per share increasing 56%. Now, with revenue increasing, expenses decreasing, and when the management team is buying back nearly 7% of shares outstanding in a single year, you're going to get an increase of 56% in net income per share or earnings per share. And this really goes to show PayPal's price to value strategy. Alex, Chris, and the management team have been talking about this a lot. They're pricing to value, not pricing to growth. So they are sacrificing some volume, whether it's in branded or unbranded checkout, to retain a higher margin. And we're starting to see that pan out. And when you couple it with buybacks, you're going to get really strong net income and earnings per share growth. Now, looking at some other metrics, you can see right here, total payment volume increased to 3% year over year. And then they derive revenue from that. And then if you take this revenue figure and actually divide it by the total payment volume, right, that's where you actually get PayPal's transaction take rate. And then you actually have their transaction margin here, which is after all of the expenses incurred in the transaction after their revenue. So that is what this figure right here. Transaction margin dollars net of interest on customer balances was $3.4 billion. Looking at the actual segments of the business, you can see a branded checkout, which is essentially just the PayPal button, which accounts for 30% of total sales, fell 29% of total sales and grew by about 4% or 6% excluding the leap day. P2P, so person to person, which is 27% of revenues, grew 8%. PSP, which is the Braintree segment, grew only 2%. Now, this is a major deceleration, and it's part of the reason why the stock has actually come down from its highs. The market doesn't like to see this deceleration. However, this is all a part of their price to value strategy. You can see this now makes up 44% of their business. This PSP is the lion's share of their business. Venmo, which makes up 18%, grew 10%. We are actually seeing an acceleration in growth in Venmo as well as P2P, and then branded is roughly in that 4 to 5% ballpark. So yeah, we are seeing a massive deceleration here in PSP, but it does look like we are seeing acceleration in growth in a lot of the other segments, which is really encouraging. If the management team can accelerate their PSP business, you should see PayPal's price to value strategy with growth in PSP really provide outsized shareholder value. You can see active accounts actually grew sequentially from 434 to 436 and grew 2% from the same period last year. Monthly active accounts was also up 2%. Number of payment transactions did fall significantly, but there's a lot of engineering going on here with them closing accounts. This is not necessarily a bad thing per se, and you can see the number of transactions per PSP actually increased, and ultimately this is the figure you want to watch if you ask me. And then looking at their full year guide, they're guiding for about 4 to 5% in transaction margin growth, or essentially net income. Non-GAAP, non-transaction operating expenses of about 8.8 billion. Their effective tax rate anywhere from 21 to 22%, right? And then non-GAAP EPS of about 6 to 10% growth. It's such a wide margin right here, but you're looking at about $5.10 at the upper end. Just for record, PayPal reported $1.29 this quarter. So, if you annualize that figure, you're looking at about the top end of the $5.10 range right there. That's non-GAAP. Sorry, the GAAP is actually $4.95, roughly the same, anywhere from that 7 to 9% growth range. They're looking for free cash flow of 6 to 7 billion, 6 billion in share repurchases, and about CapEx of about $8 billion. So the company is still looking for growth. They reiterated this despite all of the macro uncertainty. When you get a strong quarter like PayPal just had, despite what we saw with the revenue, when you get a strong quarter coupled with reiterating guidance, that is why the stock actually did what it did. Now let's talk about some things to watch. I think you want to look out for the Braintree segment. That is the PSP segment. If Braintree can re-accelerate growth, that is going to be very, very beneficial for PayPal looking out to 2026, 2027. The next thing you want to watch is active accounts. If they keep growing, that's a positive, and that's further going to support revenue growth. And then you also want to keep an eye on margins and then by extension revenue. If revenue doesn't accelerate, that is where you're going to have to change your thesis on PayPal. But right now, as it is with the moat, I would say the moat is still a narrow moat and it is unchanged. And the thesis for PayPal is intact. And the thesis being a lot of buybacks, great valuation, and the management team increasing margins, waiting for revenue to accelerate as management execute. That is ultimately how you're going to get, that $90, $95, $100 range for PayPal. Now, looking at the valuation of the stock, PayPal trades at such a crazy valuation. It's just wild. EV to EBITDA and price to earnings ratio of 9 and 13. Now, this is the next 12 months. It's very, very cheap. PayPal's price to free cash flow yield of 9.6 times, and it has a 10% shareholder yield. This is very, very cheap compared to many stocks in the payment space. What returns can you expect from PayPal over the next 5 years? If you plug in the current revenue estimates, right, and we look at a net margin of 14.2%, and we expand that to 16% with growth of roughly 4 to 5% over the next 5 years, you'll end up with a $39 billion revenue figure, $6.5 billion in net income. You slap on a 17 multiple onto that, subtract the net debt, divide by shares outstanding, and shares sequentially decreasing by about 4% every single year. You get a 2029 stock price of $144. The current stock price is $64, and that's a 17% return per year over the next 5 years. If you think 17 is a bit rich, you can stick a 15 multiple and you'll get about a 15% return on that. If you stick a 12 multiple on this, so no multiple expansion or contraction, right? You should get about a 12% return over the next 5 years, which is still better than the S&P 500's average return over the last 50 years. And this is why PayPal just makes sense, because even at these like a mid-teens multiple, well below the market multiple, you're still getting outsized growth simply on the back of some margin expansion, revenue growth. And if management execute along with their longer term goals, which is for 10% transaction margin growth and like double-digit EPS growth in the very long term, then you can really see some amazing compounding happening from a stock like PayPal. On technical charts, it's still below its 200-day moving average. This right here, the $65 to $55 zone, this gray area right here, this is the buy zone. This is where we broke out and made that massive move to $95 at the end of last year. And this is ultimately where you want to buy PayPal, looking for a move back to those 52-week highs. I definitely do believe we'll get there if the management keep executing the way they have. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.